The holy grail of value investing is margin of safety. A margin of safety exists when you can buy a stock below its intrinsic value, and therefore you have a margin of safety as the stock has the potential to return back to more normal valuations. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. This is one more of my Tuesday subscriber request series where I've been asked to showcase some dividend growth stocks. And I've got several that I'll be showcasing over the next couple of weeks here. This won't be my only one on dividend growth stocks, but I'm going to feature 5 today that have 2 attributes that I think are important for the dividend growth investor, the value-oriented dividend growth investor, I should say. One is dividend yields, and I've got 5 stocks here that have an attractive dividend yield, and the next would be margin of safety. All the 5 stocks I'm going to showcase now can be purchased below their intrinsic value, and in this overheated market, that's a real plus. So let's look at the 5 dividend growth stocks that I've picked out for you today. We've got 3M, Altria, better known with the symbol MO, the old Philip Morris, Omnicom Group, Rowe Price, and UGI Corporation. So we've got a nice diversity here. We've got industrials, consumer staples, communication services, financials, and a utility, a gas utility stock. Now, one thing that I wanted to point out, that I pointed out in the beginning of this, if you look at the dividend yields, all of these are yielding over 3%. Altria is yielding almost 7%. We've got 3M at over 4%, and then the rest of them are at 3% plus. That's real important in today's market where you've got dividend yields in the 2.5% range as being what I would call normal. So these stocks offer above average yield, plus they also offer dividend growth. So let's go ahead and look at them in order, if you will, from the standpoint of why I like them. The first I'm going to start with is 3M. Now, I talked about all of these stocks having a margin of safety. 3M is one of those really high-quality companies. It's an A-plus rated company that typically trades at a premium valuation. If you look at this graph now, the orange line would theoretically be the intrinsic value for the ordinary company. For an extremely high quality like 3M, the market likes to put around a 20. It's 19.68, but around a 20 PE. I do want you to notice that it was just during the recession of 2008 and 9, and of course the subsequent years after that where you could buy this at a real attractive valuation level. Otherwise, you had to pay a premium, multiple, something in the 20 PE range. Now, recently, the stock corrected down to where it was attractive again, where it fell down to a 14 PE. That was in March of 2020. But then notice how it rallied again. And now, again, the stock has fallen to a below 15 PE, 14.53. So the margin of safety here is the propensity for 3M to move back into a 20 multiple stock. So if I look at the forecasting graphs here and I pick, roughly I'll pick a 21 multiple here, you can see that that would represent extremely good returns. If I use the normal multiple forecast graph of the analyst, you can see that the margin of safety here is rather broad. You're looking at a stock that is theoretically worth something around $205 or $206 a share in theory, that you can buy at $147 a share, with a 4% dividend yield. So 3M looks very, very attractive here, and it's, of course, one of the really high-quality stocks. If you look at its historical dividend growth rate, the company's averaged 8.56% dividend growth over the last 20 years and 8.31% on the compound average growth rate. If I shorten that time frame to 10 years, we still have 8% compound growth rates for 3M. So 3M looks very, very attractive right now. The next would be, of course, Altria, or the old Philip Morris, MO. They still carry the symbol MO, which stood for Morris. And what I really like about this company, note the consistency of this company's earnings growth, averaging just under 8% a year. The company did get extremely overvalued. As you can see, the price got significantly above the orange line in 2017, 2015, etc. And then, of course, we've had this big correction, and the stock has been trading at an attractive valuation for the last several years. If you look at their dividend growth rate, Let's just look at it for the last several years here. You can see that they, again, have averaged over an 8.54% dividend growth rate. So once again, I really like this stock for its margin of safety. It's trading below its intrinsic value, which I would pay somewhere between $69 and $72 a share. You can buy all you want at $51. You get just under a 7% dividend yield, 6.96. In fact, let's check it today and see what's happening today. If I real quick go to the Wall Street Journal and get a quote on it, it's down today. So the dividend yield is actually over 7% all of a sudden. So that's, even makes it more attractive. So you got a good opportunity to buy it. You've got a nice margin of safety built into the stock. It's BBB rated and has a really spectacular dividend record. Again, if you look at the long-term dividend record of this company, it's increased the dividend by double digits, 8% over the last several years, as I mentioned. The next one, we're going to look at Omnicom Group, which, of course, is one of the largest advertising agencies in the world. The company has been a pretty consistent grower at over 7% a year. The stock has very often traded at premium valuations during its history. You have a nice opportunity of the flash crash that happened with COVID. Of course, it created a down year of earnings, really created a real bargain with a real margin of safety. You can see how it performed after that, even to today, where now it's trading below average. In other words, it has a 12.6 PE and a 3.33% dividend yield. This is for a BBB plus rated investment grade company. If you look at its performance, the dividend growth rate has been double digit on this company. And again, you can get a 3.3% dividend yield here with a nice cushion or a nice margin of safety on Omnicom Group. Looking at it longer term, that could very well lead to double-digit 15 to 20% or better rates of return going forward. So that's Omnicom Group. Rowe Price is one of the leading money management firms in the country. You can see we've had a big drop in price. Now, one thing I want to point out about Rowe Price, you have a beautiful margin of safety in here. You have a stock that has increased their dividend by 14% a year, and even more recently, it's been increasing it by 28, 18, and 20%. So we've got a company that has a great record of increasing its dividend. Now, there are some inconsistencies here in forecasts. FactSet has a $12 earnings for this year. Zacks has $12.31, and I note that by checking Yahoo Finance, they have about $12.25. So there are some discrepancies. And also, just to give you a point, when you're dealing with analysts, this is why your own research is critically important, and you do have to research these. If I went to Yahoo, the next 5 years for Yahoo, they expect 12.6% earnings growth. On FactSet, the next 3 to 5 years, they expect only 2.8. And if you went to Zacks, they would expect 5.6. So we do have some discrepancies as far as what the earnings growth might be. But regardless, you can buy this stock at an 11.3 PE, a 3.35% dividend yield. And again, a company that's been increasing their dividend by double-digit rates. Even if you look at the last 5 or 6 years, they've been increasing their dividend over 15% a year. So I think Rowe Price is a dividend growth stock that is worth considering and worth researching and looking into. And the last is the gas utility, UGI Corporation. Once again, we got a 3.63% dividend yield. We have the company share price has just recently dropped, which gives us a nice margin of safety going forward. We've got good forecasts for earnings growth going forward, and this would lead us to, expecting double-digit rates of return. And again, the margin of safety factor is a big factor, 3.63% dividend yield. So that's UGI. So very quickly, we've got 5 really incredible dividend growth stocks here for you to analyze and evaluate. All of them, I think, offer a margin of safety. They all offer above average yields, and they all offer above average dividend growth. So, you might want to take a closer look at all of them. The one that, I found most problematic or confusing is Rowe Price, but yet Rowe Price is really a premier, money management firm. So I don't think you can go wrong buying it at these levels. Anyway, this has been Chuck Carnevale saying, welcome to my Subscriber Request Tuesday. I hope you enjoy this. We're looking for some dividend growth stocks. I've got about 15 or 20 more that I'm going to be showcasing over the next couple of weeks, offering different attributes and different categories. These I particularly liked for the margin of safety capability that they offer. They're all very high-quality companies with good, consistent historical track records, and I think they all have bright futures in the longer run. So you might want to look at them very closely. If you like the video, give me a like, ring the bell, subscribe to the channel if you haven't already. And by the way, check out our Fast Graphs Value U Academy. For those of you looking for help on analyzing stocks, as I'm recommending that you do, the Value U Academy can help you understand financial statements a lot better. And to me, they're really worthwhile, and it's free of charge for all comers. Thanks for watching.